Welcome back to the Deep Dive. Today we are taking a close look at the financial health and strategic direction of a really big player in the U.S. healthcare solutions world, Sagility Ltd.
That's right. If you're trying to understand how one of these major tech and service providers, the ones deeply connected with U.S. payers and providers, is handling all this cost pressure and making a big shift towards AI.
Then this deep dive should give you exactly what you need.
Definitely. Our goal here is to sort of synthesize these detailed, unaudited financial results and operational updates they just released. This covers their Q2 and the first half, H1, ending September 30, 2025, so their fiscal 26 period.
And there's some immediate news, too.
Yeah.
The results were just approved October 29th, and right alongside that, the board approved an interim dividend. It's for 0.05 per share.
Yeah, it might seem small, that dividend amount, but it's actually a pretty clear signal, isn't it?
Signals stability, you think?
I think so. It reinforces that they're operationally strong in generating cash. Even a small dividend sends that message. And for anyone tracking the details, the record date is November 12th, 2025. Payout by November 28th.
Okay. And just to set the stage fully, Sagility is all about healthcare, right?
Yeah.
Primarily supporting U.S. payers and providers.
Exclusively healthcare focused. Yes, that's their domain.
All right, let's get straight into the core numbers then. Looking at Q2 for their fiscal 26, the performance seems, well, pretty impressive, especially year over year. What are the sort of headline figures?
The headlines are certainly strong, yeah. They definitely point to some serious momentum. Revenue for Q2 hit $16,585 million.
Which is about?
That translates to about US $189.4 million. And that's showing really robust 25.2% growth compared to the same quarter last year.
Oh, okay. 25% growth. That's significant in this environment. But you always wonder, right, how much of that big jump is just from buying other companies? What about organic growth?
That's always the key question, isn't it? Especially with services companies. And the good news here is the underlying business seems really strong. Organic growth, so stripping out acquisitions, came in at 16.0% year over year. Even if you adjust for currency swings, constant currency, it's still 11.1% organic growth. That tells you they're winning new deals and keeping clients happy. Real underlying strength.
Okay, so the top line looks solid, both overall and organically. But investors, they always look at the bottom line. And Sagility seems to put a lot of emphasis on these adjusted numbers, adjusted EBITDA, adjusted PAT. Can you maybe unpack that a bit? What are they adjusting out?
That's a really good point. They're basically trying to give a clearer view of the core operational performance. So they adjust out things that can be kind of noisy or one-off.
Like what specifically?
Mostly things like M&A earnouts from past deals, like the Broadpath one they mentioned, and also non-cash stuff, like share-based compensation for employees.
Right, so stripping that out gives you a cleaner look at day-to-day profitability.
Exactly. It lets you see how profitable the actual service delivery is without those other sort of lumpy items.
Okay, that makes sense. So using that adjusted lens, how did Q2 profitability actually look? Because, the numbers seem pretty remarkable.
They really are quite striking. Adjusted EBITDA landed at $4,352 million. That's a very healthy margin, 26.2%.
And the growth there?
Also strong. Up 25.6% year over year, pretty much right in line with the revenue growth. But honestly, the adjusted profit after tax, the PAT, that's where the story gets really interesting.
Okay, lay it on us. What did the adjusted PAT look like?
Adjusted PAT hit $3,010 million. That's an 18.1% margin. And here's the kicker. That number showed an 84.0% growth compared to last year.
84%. Year-over-year growth in adjusted net profit.
84%, yeah. And the adjusted basic EPS, earnings per share, reflects the same thing, also up 84.0% year-over-year to 0.64.
Wow. Okay, hold on. 84% profit growth. That's not just trimming costs. That's a massive jump in efficiency or something. Is this sustainable? Are they, cutting back on investment for short-term gains?
That's the natural question, isn't it? But if you look at what they're saying about their strategy, it seems driven by efficiency, not just, slashing R&D. The CFO attributed this huge jump directly to operational efficiencies and disciplined cost management. And that ties directly into the strategic pivot towards AI-enabled delivery that we'll probably get into more. It suggests they're doing the work much more productively.
And this isn't just a one-quarter blip, right? Looking at the half-year, the H1 numbers.
Exactly. It holds up. The half-year picture confirms the trend. Revenue growth for the first 6 months was 25.5% year over year, so very consistent. And importantly, the adjusted PPAC growth over that full H1 period was 62.4% year over year.
62% over 6 months.
Yeah, that kind of earnings acceleration over half a year really suggests that the strategic changes they've been making are paying off quickly in terms of efficiency.
But that kind of profitability, though, it often comes with risks. Like, are they too dependent on just a handful of big clients? How's the client diversification looking?
That's actually a really strong part of their story right now. They seem to be managing that concentration risk, which plagues a lot of service companies, quite effectively.
Oh, so.
Well, the revenue they get from their top 3 clients has come down quite a bit. It was 72.4% back in fiscal 23. Now, for the trailing 12 months ending this September, it's down to 63.1%.
Oh, wow. That's nearly a 10-point drop in concentration in about 2 years.
Yeah, it's a significant de-risking of the client base. That's a major strategic win.
And are they just signing lots of small deals, or are they actually landing bigger fish, more strategic accounts?
They seem to be landing the bigger, stickier ones, too. The number of clients paying them over $20 million a year has actually doubled. It went from 4 in FY23 to 8 just in the first half of this fiscal year.
Doubled the number of big clients.
And just the sheer volume, the total number of active client groups they work with has exploded. It went from 35 back in FY23 to 82 now.
82 active groups. It's almost a 130% increase.
Yeah, it speaks volumes about how much they're expanding their reach in the market.
Okay, interesting. And within that, they mainly serve payers, right? Insurance companies, managed care organizations. Is the growth balanced across their segments?
Payers are still definitely the main chunk, yeah. About 88.5% of the Q2 revenue came from payer clients. But interestingly, the provider segment, hospitals, doctor groups, that smaller piece actually grew faster.
Faster growth in the provider space.
Yeah, provider revenue was up 33.4% year over year in Q2, whereas the payer side grew 24.2%. So still strong growth for payers, but providers are accelerating faster off a smaller base. Could signal a gradual rebalancing over time if that continues.
Right, okay. And to support all this growth, more clients, more revenue, they must have a huge operational footprint. What does that look like now? Employees, locations.
Oh, it's massive. They ended Q2 with 44,185 employees. That's up over 15% from last year.
44,000 people.
Yep. And they're spread across 5 countries: India, the Philippines, the U.S., Jamaica, and Colombia, operating out of 34 different delivery centers. It's a huge global operation.
Managing a workforce that size, especially when you're growing fast and talent is tight, attrition must be a constant headache.
It absolutely is. Their voluntary attrition rate, it's still pretty high. It came in at 26.3% for Q2, but it is relatively stable compared to last year.
Still, over a quarter of the workforce leaving voluntarily each year.
It's high, no doubt, but it's a really persistent challenge across the whole industry, especially in these high-growth service areas. They seem to be trying to combat it, though. They highlighted getting certified as a great place to work in India and winning an award for service excellence in the Philippines.
So, investing in culture and recognition to try and stem the tide.
Seems to be the approach, yeah. Trying to make it a better place to stay, manage that churn.
Okay, let's pivot to strategy then. The management commentary really hammers this idea of moving beyond traditional service models.
Yeah.
Paying per person or per transaction. Why the big push to change the commercial model now?
Yeah, the CEO, Ramesh Gopalan, was very direct about this. He said their clients, the U.S. payers and providers, are facing immense, almost existential pressure on their own profitability.
Right, we hear that a lot.
So clients aren't just looking for small savings anymore. They need big, guaranteed cost reductions, transformational change. And Sagility realized the old ways, just selling hours, couldn't deliver that level of impact.
So client pain is forcing the change.
Exactly. It's driven by client needs. They need these transformational capabilities. And Sagility is responding by pushing AI, automation, and outcome-based deals to guarantee those results.
Okay, so it's less about selling labor, more about selling transformation and sharing the risk somehow. This brings us to these new contract types like PMPM and GainShare. Let's start with PMPM. What exactly is per member per month?
All right, PMPM is a really fundamental shift. Instead of billing for every call handled or every claim processed, the client pays Sagility a flat fee each month for every member enrolled in their health plan.
A flat fee per member.
Yes. And that fee covers everything: the tech platform, the operational staff, the whole service. For a client CFO, the appeal is obvious: cost predictability. budget certainty. No more worrying about volume spikes blowing up their costs.
Okay. But that sounds much riskier for Sagility, doesn't it, if their own costs go up or if they're inefficient?
It definitely puts the onus on Sagility to be efficient, and that's where the other piece, the gain share model, often comes in. It aligns the incentives.
How does gain share work?
So if Sagility uses its tech, its AI, its process improvements to drive costs down for the client below an agreed-upon target or commitment, then Sagility gets to keep a share of those extra savings. It directly rewards them for delivering efficiency beyond the baseline commitment. It turns their efficiency into shared revenue.
Okay, I see. So PMPM gives the client predictability, and gain share motivates Sagility to outperform. There's a specific example mentioned, this transform in place idea, where offshoring wasn't enough anymore.
Yeah, that was a really interesting case study. It involved a large national player, a client where they'd already squeezed out most of the savings you could get from traditional levers, like moving work offshore, diminishing returns, basically.
Right, they hit a wall.
Exactly. So Sagility came in and built a custom solution using a mix of generative AI, machine learning, advanced analytics, layered on top of the existing operations.
Why the result?
They delivered an additional 20% or more in savings, on top of everything that had already been done through offshoring and process tweaks.
20% more savings purely through AI and advanced tech. That's probably a big part of that 84% growth story we talked about earlier.
Almost certainly. It demonstrates that AI isn't just, a buzzword for them. It's a real tool delivering measurable, significant efficiency gains. That's the core of their future growth narrative, it seems.
And they're leaning into it even more now.
Absolutely. Building on successes like that, they're now talking about offering a comprehensive, GenAI-powered, cloud-based platform for customer engagement members, brokers, providers.
And the savings potential there.
They're aiming for really substantial savings, somewhere in the range of 25% to 40% across those interactions.
25 to 40%.
Yeah.
How? Where do those savings come from?
It seems to be a two-pronged approach. First, using AI for transaction containment, getting more things resolved through self-service, automated workflows, stopping issues before they need a human.
Okay, automation and deflection.
Right. And second, boosting the productivity of the human agents when they do get involved. Using agent assist tools powered by AI to help them find answers faster, handle calls more efficiently. It's about overhauling the entire workflow.
Okay, so that's the internal strategy. AI, outcome-based deals, driving efficiency. What about the external environment? The investor deck mentioned a couple of big legislative things. Let's start with the opportunity of this marketplace integrity and affordability final rule.
Right. This seems like a direct positive for them. The expectation is that this new rule will significantly increase the need for payers to do more rigorous, often automated, validation around eligibility and enrollment.
More checks and balances required by regulation.
Exactly. And since Sagility has already invested in building digital tools for exactly these kinds of administrative tasks, they're really well positioned to meet that growing demand. It's regulation driving need for their solutions.
Okay, so that's a potential tailwind. But then there's the potential headwind. The Hire Act 2025 proposal. That's the one proposing a big 25% excise tax on payments for outsourced services, right? That sounds like it could be really damaging.
It definitely sounds alarming at first glance, yeah. It's been getting headlines, but it's important to put it in context.
Okay.
First off, as the company points out, this bill hasn't actually passed the Senate or the House. It's still just a proposal. Second, their view is that even if it did pass, sending work offshore would likely still be significantly cheaper than keeping it onshore.
So the cost advantage remains, even with the tax.
That seems to be their calculation. But third, and perhaps most strategically relevant, they argue it would likely just accelerate clients' desire to adopt more technology and automation.
Interesting. So if the tax makes traditional offshoring less attractive purely on cost, clients will push harder for AI solutions.
Which is exactly what Sagility is trying to sell them anyway. So, paradoxically, they see it potentially reinforcing their strategic direction towards technology-led transformation, regardless of the outcome.
That's a pretty resilient strategic posture. Okay, one last point on financials. What about their debt situation?
Yeah, the CFO, Sarvabhuman Srinivasan, made a point of highlighting this. They're very focused on keeping the balance sheet healthy. They're actively paying down net debt.
And the target?
The plan is to have net debt fully repaid by the end of their fiscal year 2027. So strong growth, improving margins, and paying down debt, it paints a picture of pretty solid financial discipline. Frees up capital for more tech investment down the line, too.
Okay, let's try to quickly wrap this up then. If we summarize this deep dive, Sagility is posting really impressive growth, double digits on the top line, But truly spectacular 84% adjusted profit growth in Q2.
Yeah, driven by efficiency. And strategically, they're successfully reducing reliance on their biggest clients.
Right. Diversification is working.
Yeah.
And the core strategy shift is this aggressive pivot away from selling labor hours towards these complex outcome-based contracts.
Using models like PMPM for predictability and gain share to align incentives.
All aimed at delivering guaranteed significant cost savings for their healthcare clients, powered heavily by AI and automation.
Exactly. That successful margin expansion really seems fueled by these operational efficiencies and the technology transformations they're implementing. Their investments seem laser-focused on building the capabilities to win these newer, more profitable risk-sharing deals.
Which leaves us with a final thought, something for you, the listener,
Yeah.
to consider. Sagility is clearly pitching itself as building an AI-ready, healthcare-centric future workforce. Their own case studies show AI delivering massive savings, 20% to 40%, through changing how work gets done. So given they employ, what was it, over 44,000 people, how quickly is that AI adoption going to fundamentally change the jobs, the skills, the sheer number of people needed within that massive workforce over, say, the next couple of years? Managing that internal transformation, that upskilling challenge, that's got to be the critical thing to watch.